Joining us on the show is Jaspreet Arora, Head of Research at Systematix Shares and Stocks. Welcome to the show, Jaspreet. To start off with, overall, if you go to see with regards to where cement as a space is concerned, what's your expectation in terms of the volume growth for FY19?
We're expecting anywhere between 9 to 10% growth. So far we've been doing around 15% on a YTD basis. I think that's expected to taper off because of multiple reasons. One is obviously there is a high base effect which will taper off starting November till March. Second is the monsoon has been not great, and lastly there might be some bit of pressure from the NBFC liquidity squeeze that might be seen to some extent in the second half of this year. So if you put all these things together, along with some bit of rise in GSEC rates, along with the fact that so far the demand has been top heavy in terms of the top 5 or 6 states have been contributing the maximum portion of it. So put all these things together, I think from a mid double digit, we expected to close it anywhere between 9 to 10% for the current financial year.
Right, so 9 to 10% is the kind of expectation with regards to where volume growth is concerned for FY19. But if you have to break it up with regards to different regions, where do you see demand picking up, and whereas in certain regions, where do you see stagnation or tapering off effect to come in with regards to demand growth?
So far, I think the trend has been that South has been the outperformer, clearly growing in excess of 20%. And within that, the big contributors have been Andhra Pradesh, Telangana, and Tamil Nadu. After that, I think it will be the eastern region, where again the growth has been in excess of 15%. So I think that kind of trend will continue for most part of this financial year. And all the other 3 regions would see low single digit kind of a number. So they are primarily the northern, central, and western regions. They are likely to see anywhere between 5 to 7% kind of a number. So clearly, South and East are the outperformers.
So South and East are the outperformers with regards to where demand is concerned. Now, with this kind of strong demand and volume growth, Jaspreet, if you see the price trend, we've not seen that kind of a price hike by cement companies what we saw last year. Do you think EBITDA per ton is something which will be under pressure this time around on the back of input cost inflation?
So clearly this year, on an average basis at an industry level, we expected to see the EBITDA per ton declines anywhere between 5 to 15% for the industry, and company specific it could be different. And the primary reason for that is that the input cost pressures have been huge, primarily from pet coke, followed by coal, and followed by diesel. All of them have risen in anywhere between 15 to 25% on a YY basis. And that has not been supported by adequate price hikes. So put these things together, despite a very good volume growth, the EBITDA per tons are expected to decline this year, which is the current financial year, FY19. Next year, it depends again how much there are price hikes, because next year the input cost pressures may not be as huge as we've seen this year. So if they are lower and there are moderate price hikes, the chances are next year would be slightly better off. Financial year FY20 might be slightly better off.
Right. Jaspreet, we've just heard from the Cement Manufacturers Association that have come ahead, in fact, and warned that the cement prices could go up by almost 10% in the next 6 months. And this is mainly on the back of higher fuel as well as transportation cost. Now, do you think the 10% price hike that is anticipated in the next 6 months is going to be enough to go ahead and cushion the kind of margin pressure that we have been talking about right now?
Yes, absolutely. I mean, if they go up by that much, it will more than compensate for all the cost pressures that we've seen. But I just want to make a point here that it's going to be very difficult to do that kind of hikes in the next 6 months. I mean, purely because this is an election year. Anything you do would be seen as trying to may not go down well with the government. And second, obviously, is that there is the incremental demand is largely from the infrastructure sector, and which is B2B. So anything on the non-trade side, it's very difficult to push that kind of price hikes. And even if they do, I mean, typically we have seen the price hikes once taken, they kind of taper off. They kind of withdrawn back in the subsequent weeks. So we need to see how much of it really gets absorbed and how much really gets withdrawn over a quarter or so.
Right. Jaspreet, apart from that, another point that we want to talk about over here is with regards to where the capacity addition is concerned, because we are looking at almost around 60 million plus tons of capacity addition that is expected to come in between, say, FY19 to 21. Now, do you think that is something that could actually impact the utilization rates?
Utilization rates, we're expecting it to move up. I think on an average about 2%, 2 to 3% every year for the next 3 years. So I think if you take that into account from 68, 69% last year, we might be closer to 75% by March of 21. So that kind of trend can be seen. Is definitely looking possible. But the bigger picture is that is 75 adequate for the industry to get back the optimal return on capital, let's say, upwards of 15%? I don't think so, because the last time we had seen those kinds of return on capital in excess of, in high double digit, it was in a period when the utilization rates were anywhere between 80 to 95%. So till the time they cross 80%, it's going to be very difficult on a sustainable basis. I think it's going to be very difficult for the industry to do the return on capital closer to 15% or more.
Right. So with all of this said and done, if you have to break it up with regards to regions, which region, according to you, would be better placed in terms of utilization rates?
So North is definitely at the top in terms of the demand supply gap. There the utilization rates are currently closer to 85%, followed by West, which is pretty similar, and followed by Central, which is about 80%. So I think the problem is largely in East, which is closer to 70%, and the biggest is in South, which is closer to 55%.
Right. So with all of this that we've discussed with regards to margins, the EBITDA per ton, as well as the utilization levels as well, what would your call be on the sector at current levels, and what would you advise investors?
So it's kind of cautious stroke underweight. I think for some time, I think for the next 2 quarters at least, I think this kind of pressure will continue for all the reasons that we discussed before. And I think the view will only change towards the end of this financial year, by when hopefully much of the cost pressures will be over, and we'll have far more clarity on the financial year 20, because a lot of it depends on how some of the state governments and the new central government takes shape. Because at the end of the day, if infrastructure is driving the demand, then obviously how it will shape up, for how infrastructure demand shapes up for the next financial year, will be a function of whether we have a stable government or not.
Right, so we will have to wait for the next 2 quarters as well for some clarity to emerge on this front. But apart from the sector, if you have to take a stock-specific view as well, overall, what is your call? Anything that looks interesting from the stock-specific space?
So we have a sell on UltraTech Cement, Shree Cement and Ramco Cement, while we have a hold on JK Cement and Orient Cement. From the not rated stocks, and which are looking attractive from an investable investment perspective, is largely 3. So from a large cap, I think ACC is what would fit into that category. From a mid cap, it will be Dalmia, and from a small cap category, it will be Heidelberg, which is looking attractive. But again, the only thing to highlight here is, given that the overall sector may not do wonders for the next 2 to 3 months, I think these are the names which will be relatively better off, and one can possibly look to accumulate on declines, or just keep them on the radar and take an individual call based on their risk reward matrix.
Right, so Jaspreet, ACC, Heidelberg, as well as Dalmia Bharat, 3 stocks which do not have a rating at your end right now, but these could be investment ideas as well from the entire cement pack. In fact, you have Heidelberg as well as ACC, which are trading in the positive as well. In terms of valuations, Jaspreet, if you have to look at the Indian cement companies versus the global cement companies, do you think the valuations are really stretched?
Correct. So I think in our report, we have looked at both the comparisons, which is the Indian cement stocks versus the global cement, where again they are trading at premiums anywhere between 50 to 80% on parameter to parameter basis, and be it EV, EBITDA, price to book, or PE. And while the return on capital is slightly inferior, and the growth rates are not too different over the next 2 years in terms of the earnings CAGR. And while if we do that similarly for the Indian cement comps with the companies with the metal companies, there again the gap is pretty huge. So I think, and compared to their own historical averages, which is the last 10-year average, if you take of the Indian Cement Universe, they are again at a premium, anywhere between 10 to 20%. So despite the far lower return on capital, so I think in all parameters they look a tad on the higher side, and possibly this quarter's earnings growth will show some light as to how we might end this financial year, because then we will have clearly at least the first half into account to take for it.
Right. And very lastly, Jaspreet, if a re-rating has to come in with regards to where the cement space is concerned, what are the key triggers that could lead to a re-rating?
So the only re-rating is possible from sustainable price hikes. So again, these are not price hikes; these are sustainable price hikes. So once you announce it, and if at the start of a quarter or a period, and if it gets absorbed, let's say for the whole of that quarter, then obviously that is a pleasant surprise, and that would lead to kind of re-rating, because then obviously it is coming on the back of most of the headwinds and cost pressures, and if it gets absorbed, then obviously people will take that as a positive surprise and start building into the earnings, and that will also stop the earnings downgrade that has been happening for the last couple of quarters.
Right. All right, Jaspreet. Pleasure speaking to you, and thank you for sharing your views. So sustainable price hikes is something that could be the only trigger that could lead to a re-rating on the sector. But at least in terms of stock-specific action, ACC, Heidelberg Cement, as well as Dalmia Bharat, 3 stocks which look as investable bets as well at current levels. So that's the story with regards to where the cement space is concerned.